Most people believe the more you earn, the more taxes you must pay. But that is only half the truth because the wealthy follow a completely different system. High-income earners often struggle with heavy tax bills because their income is treated as salary, which is taxed at the highest rates. The wealthy, on the other hand, design their income in ways that reduce how much is exposed to taxation. Instead of relying only on salary, they shift their focus toward assets that generate income differently. When income comes from assets rather than effort alone, the tax treatment begins to change significantly. One of the most important distinctions is between earned income and investment income, and this difference shapes everything. Earned income is taxed immediately and heavily, while investment income is often taxed at lower rates or delayed. This is why building assets becomes the foundation of long-term tax efficiency. When money is earned through structured investments, it can grow with less immediate tax pressure. Another key idea is understanding how capital gains are treated compared to regular income. Capital gains, especially long-term ones, are often taxed at a lower rate, allowing more money to stay invested. Keeping money invested for longer periods not only grows wealth, but also reduces tax impact. The wealthy are patient with their investments because time itself becomes a tax advantage. Instead of withdrawing profits quickly, they allow assets to appreciate over time. This creates a powerful cycle where growth continues while taxes are minimized. Another strategy involves using legal business structures to manage income more efficiently. When income flows through a business, it opens doors to deductions and expense management. Business-related expenses can legally reduce the amount of taxable income. For example, tools, equipment, and operational costs can all lower the final tax bill. This means the same income can result in very different tax outcomes depending on how it is structured. Another powerful approach used in wealth systems is separating personal income from business income to control how taxation applies. When income is kept inside a structured business entity, it can be managed more strategically before personal use. This separation allows expenses to be handled in a way that reduces taxable profit legally. Many financial systems are built around understanding how money flows, rather than just how much is earned. Wealth building becomes more about structure than effort alone. A key idea is that not all money is treated equally in taxation systems. Money used for growth is often treated differently than money used for consumption. This is why reinvesting profits is a central strategy in long-term financial planning. When profits are reinvested instead of withdrawn, they continue to grow within a protected system. Over time, this creates compounding effects that increase wealth while delaying tax impact. Another important concept is expense optimization, where legitimate costs are used to reduce taxable income. Every business operation has costs, and understanding how to categorize them correctly is essential. When expenses are aligned with income generation, tax efficiency improves significantly. Some financial strategies focus on timing income to reduce yearly tax pressure. By spreading income across time periods, tax brackets can be managed more effectively. Deferring income can sometimes allow money to grow before taxation occurs. This creates flexibility in how and when financial obligations are paid. Long-term planning is more important than short-term earnings in wealth systems. Because financial growth is not just about making money, but about keeping it efficiently. The more structured the system becomes, the more control there is over taxation outcomes. Principle is using long-term structures that protect and organize wealth across time. These structures are designed to legally separate ownership from control to improve financial efficiency. When ownership is structured differently, taxation rules can apply in more optimized ways. This is why many wealthy systems focus on layered financial organization instead of single income streams. Diversification of income sources also plays a major role in reducing financial risk and tax pressure. Multiple income streams allow better balancing of taxable and non-taxable flows. Global financial planning can further influence how assets are managed across different jurisdictions,